Let's get straight to it. The financial world is buzzing, and for good reason. Something significant is happening right now that affects not just economists or traders, but every single one of us in India. Whether you're a student, a business owner, or someone managing a household budget, the latest news about the rupee is something you can't afford to ignore. The Indian rupee just hit a record low, over 90 rupees to the US dollar. This is a historic moment, and it's sending shockwaves through markets and households alike. The value of our currency is more than just a number on a screen. It's a reflection of our economy's health and its place in the world. This isn't just a number. It means everything imported, oil, electronics, even your groceries, could get more expensive. When the rupee weakens, the cost of bringing goods from abroad rises, and those costs often get passed on to you, the consumer. So, the next time you notice your grocery bill creeping up or fuel prices rising, remember, the exchange rate is playing a big role. Families with kids studying abroad, their costs just shot up. Tuition fees, living expenses, and even travel become more expensive when the rupee falls. For many, this means rethinking budgets or making tough choices about education and lifestyle. But it's not all bad news. Exporters and IT companies earning in dollars actually benefit, as their foreign earnings are worth more in rupees. This can boost profits for businesses that sell goods or services overseas, and sometimes even lead to more jobs or higher wages in those sectors. This currency swing creates winners and losers, and it's why everyone's talking about it. Investors, business leaders, and everyday people are all watching closely, trying to figure out what it means for their future. The rupee's fall signals deeper economic issues, trade, investment, and global pressures. It's not just about local events. International factors, like oil prices and global interest rates, play a huge role in shaping our currency's value. Understanding what's driving this helps you make smarter financial decisions. Whether you're planning a big purchase, investing, or just trying to save, knowing the reasons behind the rupee's movement can help you stay ahead. Whether you're running a business or managing a household, this matters. The impact is real, and it touches every part of daily life, from the price of essentials to the cost of dreams like studying abroad. So, what's behind the rupee's slide? Why is this happening now, and what can we expect next? These are questions on everyone's mind. Let's break down the key reasons. We'll look at both the global and local factors and explain how they all connect. Stay tuned as we dive in. By the end of this, you'll have a clearer picture of what's happening, why it matters, and what you can do about it. One big reason for the rupee's weakness? Foreign investment is drying up. When investors pull money out of India, they sell rupees and buy dollars, pushing the rupee down.
Investors are nervous about India's slow growth and uncertain trade outlook, so they're moving money to safer markets. This isn't just about stocks. Long-term investments like factories and infrastructure are also on hold. It's a tough cycle. Weak economy scares investors, and less investment makes recovery harder. Right now, global uncertainty means investors want stability, and India isn't delivering.
Until confidence returns, the rupee stays vulnerable. Without fresh foreign money, the rupee faces more pressure. This money drain is a key reason for the rupee's current troubles. Let's look at another big factor: trade. Trade is another headache for the rupee.
India imports more than it exports, especially oil, creating a trade deficit that keeps demand for dollars high. Ongoing trade tensions with the US haven't helped. No deal means no boost for exports. Businesses are stuck in limbo, waiting for clarity on tariffs and trade rules. The longer this drags on, the more it weighs on the rupee.
Until India can export more or cut imports, this imbalance will keep dragging the currency down. The trade deficit and unresolved deals are a double whammy. It's a persistent weakness for the rupee. Next, let's see how US decisions are making things even tougher. The US Federal Reserve's decisions ripple across the globe, including India. Every time the Fed makes a move, whether it's raising or lowering interest rates, the effects are felt far beyond American borders. For India, these decisions can mean the difference between a stable rupee and a currency under pressure. When US interest rates are high, it becomes more attractive for global investors to park their money in American assets, which are seen as safe and profitable. Investors flock to the dollar, pulling money out of emerging markets like India. This sudden outflow puts pressure on the rupee, as demand for the dollar surges. The result? the dollar grows stronger, while the rupee weakens, making imports more expensive and increasing inflationary pressures in India.
But now, the US economy is showing signs of weakness, with slower job growth and concerns about a possible recession looming. Many expect the Fed to cut rates soon, hoping to stimulate growth and prevent a downturn. Lower rates could make the dollar less attractive, giving other currencies a chance to recover. That should help Asian currencies rebound, as investors look for better returns outside the US. But the rupee isn't benefiting as much as its Asian peers. Despite the global shift, India's currency remains under pressure. India's own economic problems, like a widening trade deficit, sluggish exports, and persistent inflation, are outweighing any global positives. These domestic challenges make it harder for the rupee to bounce back. It's like being in a leaky boat. Even if the wind changes, you're still sinking unless you fix the holes. The global environment may improve, but India's internal issues keep dragging the rupee down.
All eyes are on the Fed's next move. Investors, policymakers, and businesses in India are watching closely, hoping for a rate cut that could ease some of the pressure. A rate cut could help the rupee regain some strength, making imports cheaper and easing inflation. But if the Fed holds steady or raises rates again, the dollar could get even stronger, putting more strain on the rupee and the Indian economy. The rupee's fate is tied to both global and local factors. While international trends set the stage, India's own economic health determines how well it can weather the storm. For now, India's internal issues, like weak growth and fiscal challenges, are keeping the rupee down, despite what's happening abroad. The next US inflation report and Fed meeting could be turning points, potentially shifting the balance for the rupee. But unless India addresses its own economic weaknesses, any relief from global changes may be short-lived, and the rupee could remain vulnerable. Let's see what the RBI is doing about all this, and whether their actions can help steady the rupee in these turbulent times.
When the rupee falls, everyone looks to the Reserve Bank of India. The RBI can sell dollars to support the rupee, but lately, it's been hands-off. Why? The RBI may see this as a fundamental problem, not just market panic. Selling dollars won't fix deep economic issues. Plus, the RBI wants to save its reserves for a real crisis. A weaker rupee can help exporters, so the RBI might tolerate some decline. It's a balancing act. Too much weakness fuels inflation, but a little can boost growth.
The RBI's next policy meeting is crucial. Everyone's watching for signals on its rupee strategy. The central bank's stance will set the tone for what happens next. Now, what do experts predict for the future? So what's next for the rupee? Experts say it depends on two things: a US-India trade deal and US interest rates.
If a trade deal is signed, tariffs could drop, boosting Indian exports and bringing in more dollars. That would strengthen the rupee and lift market confidence. But if talks stall, the rupee could fall further as investors lose hope. The Fed's next move is just as important. A rate cut could weaken the dollar and help the rupee. If the Fed signals more cuts ahead, the rupee could get a real boost.
The future hangs on these two big ifs. Trade negotiators and central bankers hold the keys. Until then, expect more volatility. Let's see how other Asian currencies are faring. The rupee isn't alone. Other Asian currencies are also reacting to global shifts. Across Asia, currencies are constantly influenced by a mix of international events, economic data, and investor sentiment. In recent months, the region's financial landscape has been especially dynamic, with each currency responding in its own way to the changing tides of the global economy.
While the rupee is falling, many Asian currencies like the Singapore and Australian dollars are holding steady or even gaining. This resilience is partly due to their strong economic fundamentals and proactive policy measures. For example, Singapore's robust financial sector and Australia's resource-driven economy have helped shield their currencies from some of the volatility seen elsewhere. Investors are watching these markets closely, looking for signs of stability and growth. That's because investors expect US rates to drop, making the dollar less attractive. As the Federal Reserve signals a possible shift in its interest rate policy, global capital is starting to flow back into Asian markets, boosting some currencies. Lower US rates often mean investors seek higher returns elsewhere, and Asia's emerging economies can benefit from this trend. But the rupee's unique problems make its decline stand out. Unlike its neighbors, India faces a combination of weak investment, sluggish export growth, and persistent trade deficits. These challenges have made the rupee more vulnerable, even as other Asian currencies find support from global trends. The South Korean won is also down, showing that local issues matter. In Korea's case, concerns about technology exports and geopolitical tensions have weighed on the currency, reminding us that each country's story is different. Each currency tells its own story. India's is about weak investment and trade. The country's struggle to attract foreign capital and boost exports has put extra pressure on the rupee, highlighting the importance of strong economic fundamentals.
When most Asian currencies are stable and the rupee is falling, it's a sign the problem is homegrown. It signals that India's economic challenges are more severe than those faced by its regional peers, and that solutions must come from within.
Until India fixes its fundamentals, the rupee will lag behind. Addressing issues like investment climate, trade competitiveness, and fiscal discipline will be key to turning things around. External factors help, but internal reforms are crucial. Only by strengthening its own economy can India hope to see a sustained recovery in its currency. Now let's see how this all hits home for ordinary people. The impact of currency movements isn't just felt in financial markets, it affects daily life, from the cost of imported goods to travel expenses and even job opportunities.
What does a weak rupee mean for you? It hits your wallet directly.
Imported goods, especially oil, get pricier, so petrol and transport costs rise. That means higher prices for everything from groceries to gadgets. Electronics, medicines, and even your next smartphone could cost more. Imported inflation quietly erodes your purchasing power.
Studying abroad, tuition and living costs just got steeper.
International travel is pricier too. Your rupees buy fewer dollars or euros. But there's a flip side. Exporters and IT companies earning in dollars benefit, and families receiving remittances from abroad get more rupees. The weak rupee creates both winners and losers.
Your personal impact depends on which side you're on. Let's wrap up with some practical advice. Here's how to protect your finances. Uncertain times call for smart moves. Don't panic.
If you have big foreign expenses coming up, consider buying currency now to lock in rates. Diversify your investments. Don't put all your eggs in one basket. Look at export-oriented stocks or international funds to hedge against rupee weakness.
Borrowers, watch your loans. Interest rates could change. Review your budget, trim expenses, and build an emergency fund.
Aim for a cash buffer of 3 to 6 months' expenses.
Stay informed, but don't get overwhelmed. Focus on what you can control: spending, saving, and investing wisely. Currency markets will always swing, but a solid plan keeps you steady. With these steps, you can weather the storm and keep your finances on track.